So we are starting our afternoon mini course for the weekend, and it's really a pleasure to introduce Professor Marco Avellaneda from the Current Institute of Mathematical Sciences, NYU. And Marco is one of the most well-known quants and mathematicians in the world, and it's really amazing to have him here. I know it's tough to be here on a Sunday afternoon with sunny weekend, but Marco, you are very, very welcome, and thank you again for being here.
Muito obrigado. Muito obrigado, eu vou falar em português primeiro, muito obrigado por ter me convidado mais uma vez e por essa edição de Research in Options, que deve ser a 10ª, né, mais ou menos. 11ª. Então, é uma maravilha, a gente tem que continuar com essa série, porque eu acho que está sendo super legal e trazer mais pessoas, né, atrair pessoas da indústria também, né, sempre ser mais inclusivo, né.
Indeed. Né? É verdade. De fato, nós temos bastante estudantes aqui hoje.
Eu acho que o mix ideal é estudantes, pessoas da indústria, pessoas da bolsa, sabe, e pessoas da matemática, sabe, todo mundo junto para resolver o problema, porque tem muito problema que a gente ainda não sabe, né? Como ainda tem muita coisa para se aprender. Eu vou falar em inglês porque para não ficar traduzindo o slide, porque tem muito slide. So today I'm going to talk about. I was going to give a talk on risk management. It was too close to what I did last year on options, so I decided to broaden it up to clearinghouse risk management. So clearinghouse risk management is essentially the discipline of systemic risk. You know, George asked earlier about systemic risk. Clearinghouses are one of the proposals for managing systemic risk, and they exist in all the world. So this is, in the spirit of a mini course, this is going to be 20% of my own thinking and 80% of things that are, you know, that are facts. So I will try to state the facts as I know them, and especially to put them in the context of the last 8 years since the collapse of Lehman Brothers. Clearinghouses have become important again. They exist since the 70s. They have become important, and also since we are now, I would say two things. Recently there have been some very interesting results on stress testing of the whole system of clearinghouses in the world done by the CFTC, and I brought the paper, the PDF, with me. So those of you who want to see the state of the art from the CFTC point of view, there's a beautiful paper which appeared last month, and I have it with me. You can look at it in the internet. It's about stress testing CCPs, you know. And then the other thing is I have, this is more, you know, tongue-in-cheek, if you will, I have the proposals of the Trump administration for, you know, regarding Dodd-Frank and the Financial Reform Act of 2008. And as you can imagine, you know, they are very radical. So if I have time, I can show you that too after we go through the clearinghouses to see, you know, what to expect in the future, or to think about things that we might expect in the future. But Dodd-Frank is not just, you know, capital markets, it's also bank and consumer. So, you know, we'll see if we can get to that. I also have brought the document from the Congress, from the House of Representatives. So again, if you want to read it, it's a long document, but I summarize it. So now I'm going to begin this course on clearinghouses, and mostly in general, but also emphasizing, of course, over-the-counter derivatives, like the talk that we heard, like the mini course of this morning. The financial crisis of 2007 brought attention to systemic risk in financial markets, and one of the main concerns was that over-the-counter derivatives was unregulated, that is swaps and swap-like things, and that, you know, the failure of a large market player could propagate into a chain of failures and, you know, a run on And these players happen to be banks, and banks are backed by the central bank, so it creates a systemic risk. And originally credit derivatives were at the center of collapse of Lehman Brothers. And then you have Bear Stearns and AIG. It was all about credit derivatives in different guises. And also, derivatives markets in general, because of their abstract nature and they're more, they're difficult to understand, options, futures, forwards, they attracted the attentions of regulators. And the idea that OTC derivatives could be centrally cleared took root in the fall of 2008. I remember it like it was yesterday, when the president of the New York Fed, Mr. Timothy Geithner, he was already an appointee of the Obama administration. He was going to be appointed by Obama, but he wanted to, quote unquote, prepare this piece of legislation and so forth. And, he was going to become U.S. Treasury, he was head of the Fed, New York Fed. He was going to become U.S. Treasury Secretary, so he wanted to finish that. And this led to the focus of central clearing of derivatives that then led to the same thing worldwide. And this is the story of that, in a way. And not just a political story, because risk management and mathematics plays a role and has been sort of standardized. And we will be able to touch that. So that's the mathematical part. And I will show you the questions that arise in that particular context, which may be surprising to you if you don't know them. So what is a CCP and what is it good for? A CCP is a central counterparty, but we say CCP for clearinghouse, central counterparty. It's just a name. Central clearing is a legal market framework. Usually it materializes as a company, right? It's a framework which often is put in place to protect market against systemic risk. Clearinghouses are in charge of payments, settlement, clearing, that is registering trades, in a centralized location. So they actually they register trades and they clear them. And also, it's much more than that. But this allows, for instance, regulators and investors to have a better picture of the market and to also eliminate credit risk. The way you eliminate credit risk is because the central counterparty becomes counterparty to every transaction. And these transactions are, there's initial margin and variation margin. We'll go into detail on that. So basically, rather than having bilateral trading with initial margin and variation margin and CVA and whatnot charged between banks, there's one central organization, and all trades are, we'll explain that. But just to tell you something, short selling equities also requires lending and borrowing, so they're commitments to the future. So short selling equities is also needs central clearing in a way, otherwise it gets complicated. Repurchase agreements, repos, they also introduce credit exposure. So all this thing is naturally belongs in a clearinghouse. Doesn't necessarily, in Brazil, short selling is centrally cleared. I forget the name, but I will remember. It's like an acronym, What's the acronym for the short selling, the people who do the short selling in Brazil? Hã? Não, mas qual é o nome da... Qual é o lugar onde você faz isso? Hein? Depois eu vou me lembrar. CETIP. Não, CETIP é uma câmara. Não, não é CETIP. De Genaro, meu grande amigo, Alan. Why the interest in CCPs now? CCPs have been in the context of exchange-traded securities and derivatives for many years. Okay, I already went through that. Okay, there was a lot of proliferation of credit default swap transactions. There's a chain reaction. The idea of creating CCPs for over-the-counter derivatives originated in late 2008. And the international norms, this is important, because everything has to have a logic, legal framework or principles. These principles were proposed by the Bank of International Settlements in a series of papers from 2010 to, so basically after the CCPs were created, like the first CCPs for credit, the BIS started writing on CCPs and thinking about what were the things that were necessary, and that allowed other countries to write laws and to comply with the BIS or to create an international standard. And so it became fully international since 2010. And in the United States, I would say that since 2009, 2010, central clearing was. So here's a concept, like a nice little graph, novation. Novation is something, novation means when you have, before novation, two banks or two traders make a trade, and this trade involves a derivative, so it involves maybe a fixed leg versus a floating leg payment of some kind, or some kind of promise or a forward or an option or something. And before novation, these arrows mean credit exposure. You have a credit exposure, some person may not pay. So novation means that after you do the trade, you report it to the CCP. If the trade is within the standards of the CCP, so it's for standardized instruments and whatnot, then the central counterparty becomes counterparty to both trades, and they have no longer a link. So instead of me having to rely on the credit of my counterparty, I rely on the credit of the CCP. And novation replaces the credit risk between counterparties to the CCPs. That's an important thing, novation. The other thing is netting. Another effect of CCPs is that if you have a lot of bilateral transactions, you create weird topology, to use like the topology in a social science, where you create weird networks of dependency. And in particular, you have, if you count the total notional amount outstanding here, 250 and 300, 750, you have 1250. But in reality, if you think of these as being the same instrument, you can actually say, well, if A has two trades, but if these are all novated to the clearinghouse, then the total notional outstanding is much less, because there's a lot of redundancy in the swap market. There's a lot of swaps back and forth between people, so you can tear them up, and then you get a more compact system, and so it's easier to control. And novation and netting implies compression. Central clearing, therefore, has transparency, or at least in principle, transparency, compression, and mitigation of systemic risk. Now, if you look at, for those of you that are not familiar with the system as a whole, when you access the derivatives market, you usually access it through a dealer, which is in many cases a bank in the case of swaps, but it could be a specialized dealer. And in this context, they're called clearing members. So the big participants in the CCP, those who actually novate trades, is not the small investor necessarily, although it could be. That depends on the legal framework. But the small investors, or the clients, let's call them clients, they actually trade with the clearing participants. And so the clearing participant sort of has relationships with people who trade, or hedge funds, or banks, small banks. Usually these are largely capitalized financial institutions that often are a bank or an investment bank, or maybe it's one hedge fund that is a clearing member because he manages to meet the criteria. And so this is kind of the network that we are going to be talking about. And then this network, I already tell you, there's the same network here, another one here in different countries, and there may be sort of agreements between CCPs, so it becomes kind of a complex system. The tools for risk management of CCPs. So where does the risk management part come in? So far, it looks like a legal cleaning up of, just making sure that we are not redundant, that there's a central place where you register. But then you also have several elements that mitigate the credit risk. One element is called initial margin. Initial margin is simply like a cushion of money. For those of you who traded, you know that you need to have some money with a broker, because you need to be able to make your payments or be liquidated. So if you get liquidated, I still need some money to cover the cost of liquidation. Liquidation I always will be liquidated when the market is against me. So this is called the initial margin that Professor Crépé talked about before. Everybody has to post initial margin. And then there is another thing called, which is very important, called the guarantee fund, which is a mutual pool of money. Without that, because initial margin, you can post initial margin, but what if, what if you go through your initial margin because it's a big loss, a big crash, then you have no more money in the initial margin. So then there has to be some mechanisms for liquidating and making whole, the company. So you need also a guarantee fund. And also other things that exist in this thing are loss tranches. That is, there's some capital from the clearinghouse that also you can use to pay for losses. So typically what happens is, if I'm a clearing member and I cannot meet and I cannot, say, make a payment because my position lost money, I have to pay the clearinghouse, and then I don't answer the phone or I'm not there, or then the clearinghouse has the right, and this is also a very important thing, to liquidate me. This is actually a very important point, and Brazilians always tell you that, because that's part of the framework is that when you're in a clearinghouse, your collateral and the money, your assets, it could be money or it could be bonds, they're no longer accessible by a bankruptcy court. They're bankruptcy remote. That is why the market works. Because if I go belly up, the judge that is managing my bankruptcy cannot claim the collateral of the clearinghouse as part of what will be distributed among the debtors. That collateral is made to solve the problem of paying the parties that made money when I lost money. That's what the clearinghouse also does. So a clearinghouse also has a framework which is called a commercial law framework. In Brazil, it's very strong, and that's the basis of every clearinghouse. Otherwise, it wouldn't work, because you say, oh, okay, but wait a minute, that money is part of the pool that, it's like with the buildings and the computers and whatnot, and the cash that was in, and so there are two documents, which we will talk a little bit, especially this one, the Principles of Financial Market Infrastructure. It's not very long, but if you want to be a consultant or an analyst in clearinghouses, you need to at least have read this once or have someone tell you about it. It's CPSS IOSCO. We'll talk about it a little bit. And then ESMA is the European version, also known as, it's a technical standard for the European Union. In the United States, every country has a different one because every country has different laws. And so BIS is sort of like the principles, and then every principle becomes a law in a different country, or it becomes a rule, So the risk waterfall, that's another thing that's important. When you create the lines of protection for systemic risk of a clearinghouse, what happens is that you first have the initial margin, your cushion. If the clearing participant cannot make payments and is declared in default, the initial margin disappears. After that, typically, there's some extra money, maybe not much, but the CCP itself, it's a company, has funds that help, pay the winner. Because for every winner, there's a loser, right? So suppose that, let's say, these two guys novate to me, he loses and defaults, he wins, so I have to pay him. So I need to use his initial margin. If that's not enough, I use my own money. If I can't use if my own money is enough, I can use a guarantee fund. Typically, maybe I'll use the loser's initial margin and guarantee fund, But then I can go into the guarantee fund of the other people. Then there's another tranche if you burn through the entire guarantee fund, which is a catastrophe because it's the end of the clearinghouse. And then you could have another tranche of money from the CCP, or you could actually have a rule that requires the other clearing members to make the clearinghouse whole, and that this is very controversial. A lot of these things are controversial. What is not controversial is the fact that you need an initial margin and a guarantee fund. And quantitatively, the question is, how big should the initial margin be? How big should the guarantee fund be? So before we get into the more quantitative things, let me continue a little more because, so the other thing is that every node that you see from a clearing participant really is two accounts, at least, because every clearing participant can have multiple entities. But every trading entity has a house account and a client account. Because remember, these guys are servicing clients, but they may be also hedging their exposure by taking an opposite side with another derivative. So they have their own portfolio of swaps, and the clients have also portfolios of swaps here. And both of them, so this one has collateral that goes into the CCP, that is posted with the CCP, and the house has collateral and contributes to the guarantee fund, probably for both of them, or as an entity, right? So that means that the client accounts, and also, so this is how the story is. The house cannot mix with the clients. That's you know, and the clients, both are margined separately. And then the other thing that is very interesting is that the client's securities can be held under the CP's name, it's called in the street name, or can be held in the name of the ultimate beneficiary, that is themselves. So these are two different, for example, in Brazil, BM&FBovespa, every client has an ID. So every client gets margin. You know, it's not like if you trade through Itaú, you make a trade, Itaú tells Bovespa, you know, this guy traded, and Itaú, and then Bovespa says to Itaú, who is this trade for? And Itaú says, I don't know, I'm very busy, I'm trading a lot. Okay, so it's yours. So they have to put the guarantee, the initial margin. And then at the end of the day, they say, no, it's not mine, it's this other ID. Ah, okay, fine. So that liberates, frees money from the house. So client clearing, this gets complicated, I don't want to borrow you too much, but in Europe, for example, unlike in Brazil where everything is final beneficiary, there's only, yes? Bovespa does, and EMIR says that everybody else has to offer it, but it's not mandatory. So that goes under what's called an omnibus account or or an individual account. That's what I want to cover now. You have a choice. It's more expensive if you are the final beneficiary. It gets more expensive. It's just a matter of cost because it's separate bookkeeping, right? Okay, that's a good question. You know, since I don't want to play guitar here, I can tell you I don't know either, but the EMIR regulation asks people that must offer both omnibus client segregation and individual client segregation. So the EMIR regulation is from 2012, so is it in place or not? I don't know, but in principle, it is? Okay, so that means that you have to if I say I want to be, you know, I want to be by myself, I don't want to have my money with my clearing part, my broker, it's something you would offer. You would charge for that, right? You guys just do it. That's part of the Brazilian law. That's how it is. Then CCPs must allow clearing members to open further accounts. So no netting across accounts. So you can, you know, an entity like Itaú could have several accounts, right? And that's a great question. How many people really do I think that, you know, there are very few CCPs that does that. And the reason of that is because it's expensive to do the individual accounts. I should know the answer to that since I'm giving this talk. Okay, CCPs and clearing must disclose level of protection and costs. It must have reasonable commercial terms, whatever that means. You know, you have to make a living. So I understand that CCPs make more money than exchanges in many cases. So it's a pretty profitable thing. If you ask me for how much it costs to clear a swap, I might be able to tell you. But CCPs must commit to trigger procedure for porting. So what happens if a clearing member, what happens if your broker defaults from some other client, then you could have in place the idea that your account will be ported to another clearing member. If a clearing member defaults in client request, transfer client position to another clearing member, blah, 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 step in omnibus and individual accounts, and CCPs can actively manage the risk by liquidating positions, and so on and so on and so on. So this part becomes legal. I actually think that I took this information from some lawyers meeting in some resort, you know, Linklaters. But anyway, here's a picture. You know, so here is the omnibus segregation. Omnibus segregation would be like the CME futures. You know, you go in, The clearing member takes all of this and he puts a margin for everybody. But there is some books and records about who the clients are. They still keep records, some kind of records. But it's, and so this is onerous. For example, why does Bovespa, why are they so proud that they have individual accounts? You know, they do, why they shouldn't, you know, let the market, let's say, they take it as a badge of honor, but maybe it's not that important. Okay. The individual segregation is, as the graph says, you know, everybody has a book and then maybe, but the clients do not post guarantee fund, only the, you know, so it's not the same as being self-clearing. Self-clearing is if you're a clearing member and you post VM and guarantee fund. So these people are not self-clearing, but they have their margin directly with Bovespa, let's say, to put a name, but they don't put a guarantee fund deposit. All right, so position within the account can be netted. So this becomes complicated, but it's a question of, for example, when you're in an omnibus account, your margin is commingled and it's put together, you know, and is used as, you know, so the whole portfolio has one margin. And when you're in individual segregation, you only have to put your, you know, you can get some margin back. The porting thing, you know, you have the client, which is in gray here, clearing member and the CCP. So these are the kind of contracts that bind these people together. If the clearing member defaults, you go to an alternative clearing member, and then, you know, the OTC counterparty gets, you know, now gets notified. You know, so there's a bunch of legal mumbo jumbo there. But porting is important because, see, the two things you can do when a clearing participant defaults is you can either liquidate and just close the account, and that's usually done when it's stocks or stock options and things like that. In other cases, you just transfer, you know, it's like when a bank fails, you just get the thing, another bank take over. That's cheaper. And it's easier to do. Should all derivatives be centrally cleared? So to finish this introduction to the clearinghouses, I would say that one of the questions is how many derivatives should be centrally cleared and how many should not? This is a complex question that cannot be answered by a yes, no, you know, because there's a lot of bespokeness. You know, remember before Lehman, we all were working about CDOs, the idea of the CDO. The CDO is very bespoke. There's a tranche, the super exotic derivative. That was very fashionable. Those things do not fit well, even swaptions, options on swaps, do not fit well into they're complicated because they're not standardizable. And so the push for OTC derivatives has to do with standardization. So, and also the privacy of the market makes it that a lot of dealers do not want to give, you know, they think that it's not a good idea if I have to make public the fact that I did a huge swap with a counterparty, because when I try to hedge, it's complicated. So, yeah, because the size of the deals is very big, okay. And so OTC derivative can be used to hedge each other and so forth. So for example, if swaps are cleared but swaptions are not cleared, then, you know, you can have a problem with the, you know, if either I clear everything and it reduces the cost. If my hedge is cleared but my swaption is not cleared, then the cost is bigger because I have to provide capital for both. So there's issues. And the way that I've seen this answered in the real world is incrementally. So the way that these things go in clearing in OTC derivatives is first you're allowed to clear this swap. Then you're allowed to, for example, index credit swaps. Then you're allowed to clear corporates. Okay, we're happy with jump to default. Then sovereigns. Okay, now, so it's actually in the regulatory process and in the mathematical process of validation, it's always simple to go, not to create a thing that everything is cleared or everything is not cleared. So there's a lot of issues there. Now, current issues of interest to practitioners, mostly legal. How resilient are CCPs in the case of a large clearing participant default? We never had a clearing participant default in OTC setting since we have CCPs. Size of the guarantee fund and how much each CCP should contribute. This is essential many people would not, because the money in the guarantee fund is immobilized. It can be a lot of money, so it makes it expensive. Banks do not like that. A lot of people, and also private people don't like it because, like clients don't like it. But clients said, okay, let my broker-dealer put money in the guarantee fund. The broker-dealer says, okay, but I'm going to raise your cost. How are client accounts segregated from house accounts? This is very important. That we have seen. When a futures commission broker in Chicago collapsed in 2012, 2013, it took all its clients' accounts with them, and it was a mess. And then it ported them, but it didn't port it with the cash, so created a big problem in the CME. Porting clients of CPs, ways of closing out positions. When I close out a position, should I be active? Should I be hedging and doing smart trading, or should I just close it? In Brazil, you have to close it. You can't do hedging. I consider that in the United States, in the OTC market, people are they want to hedge. They say, if I don't hedge, then I have to hedge a swap, so I have to go into the futures market. I can't liquidate a swap or an OTC position that is too big because the market will fade. There's a difference in the problem with the difference between listed derivatives and OTC derivatives. In a sense, it's not an absolute difference, but in the OTC derivatives, the prices given by the other clearing participants that are members of or people that are, it's not in a screen. So the clearing participants can decide not to bid in the portfolio that is being liquidated. And that could be problematic. And that is why default management is complicated. Replenishment of the guarantee fund is perfect for a conference in Bahia with a lot of lawyers. You can talk a lot about that. Where are we going to get the money for the guarantee fund? With bankers in the middle. And then it's complicated. No one wants to replenish. They already don't want to put money in the guarantee fund, much less winding down CCP in an orderly way also, and systemic risk posed by CCPs. That's the favorite conversation of every academic that I know. And nobody knows yet. And I think that we have a clue with the CFTC paper. So those are the issues that we have. So if you want to write a paper saying CCPs pose a huge systemic risk, someone will publish that paper. You can do a simulation and so on. Winding down a CCP in an early way, that's harder to write a paper on that. Not that people haven't tried. Okay, so now let's go to the more concrete world of what are the CCPs? What are we talking about? These are the major CCPs in the world. And, I'm mentioning the ACH, which is the bank clearing of checks in the United States, or wiring. In Brazil, there's a very good check payment system that comes from the times of the 80s, from the time of the hyperinflation when you needed to pay the money fast. So that, by the way, is one of the building blocks of the Brazilian clearing system, the system of payments. The other one being the law that is bankruptcy remote. The securities in the United States, DTCC, FIC, this is part of the DTC, which is the clearing for stocks and for government bonds, mortgages. LCH ClearNet, LCH means London Clearing House. It's a big player in securities, and Eurex Clearing, which is the Germans, the German clearing. Then for derivatives, this is for securities, so for stocks and bonds, and et cetera. For derivatives, you have the CME group, which evolved from the Chicago Mercantile Exchange, and as it became a big corporation, it absorbed exchanges, it absorbed also the clearing function of these things. And it actually is a reference because many clearing houses in other places in the world like to use the CME's risk management systems. Then you have LCH ClearNet, which is the European, they do swaps, interest rate swaps. The Intercontinental Exchange, ICE, was one of my first consulting jobs in 2008. They are the top guys in credit derivatives in the world. And they have almost the best position because the creation of the OTC function for ICE goes directly to Geithner. goes directly to that moment before the regulation when people knew that derivatives had to go OTC, and when a consortium of small banks decided to step ahead of the regulators and to create a clearinghouse. And by then it wasn't ICE, but later they sold it to ICE. And then it became part of ICE clearing, ICE Clear Credit. In exchange-traded options, it's fascinating just because of the complexity. You know, options have strikes, have maturities, there are options on volatility, there are options on futures, you know, there are millions of options that trade, hundreds of thousands of options that trade every day, and you have to close the books because one of the things you have to do is you have to give a price for everything. One of the things the clearinghouse has to do, let me not forget this, is every end of the day they have to say this is worth this is worth this, and then you have the variation margin. If you lose, you pay, and then you have the initial margin based on the new payment. So it's a whole exercise that is done overnight or several times a day in the case of listed derivatives. And, you know, in Brazil, BM&FBovespa manages, to my knowledge, maybe I'm wrong, 4 CCPs for different asset classes. Well, like CME, that also clears different asset classes. And what else can I say about BM&FBovespa? BM&FBovespa, of course, you all know, is the merger of BMF, which is a futures exchange and clearinghouse, and Bovespa, which is the stocks. And they merged in 2008. They demutualized and merged in 2008, and then embark on a big project of risk management and uniformizing, recognizing that if they're clearing stocks and they're clearing futures and they're clearing options, they should kind of cross-margin and all that. And so they did a big thing, a big project on this that is still going on, and which is very well known internationally. And then you have another huge clearinghouse called Hong Kong Exchanges and Clearing. Hong Kong Exchanges and Clearing is huge. It's in volume, it's like Bovespa. These are about comparable. So, and they do a lot of foreign exchange. They are the place closest to China, but it's not China. So you have all the offshore yuan, you know, swaps. You have a lot of crazy gambling warrants that the Chinese love, and you know, and things like that. So they have a lot of products, and we looked at a lot of them. I have worked with all of these clearinghouses except for Eurex. So I know them like from inside out. Is that good or bad? I don't know, but it's just an industry. It's an industry that, and this industry is evolving, right? And it's evolving within regulation of different countries, and it hires a lot of quants, and the quants have to do specific things that bank quants don't have to do. They have different bank quant requirements. And they also have a rollout of products. But you know, in the heydays of derivatives, a desk could roll out an exotic option in 10 minutes. They could find a crazy client that wanted a double knockout barrier on, you know, Deutschmark versus Swedish krona, and they would find a mathematician that. Here, it's more of a rollout that involves the whole systemic package. So it's more like, what kind of derivatives can we incorporate into the mix, you know? And okay, so just some numbers so that you know that these are not small things. The DTCC clears equities and corporate bonds. They also have a trade depository where you write down trades for OTC derivatives that may not be cleared, and they have a repository for loans. They also have the government and mortgage-backed securities and general collateral fund repos and TBAs. This is a very important function in the United States because, as you know, securities in Brazil too are used as collateral against you know, money, to borrow money overnight, right? How many people know that? Raise your hand. How do you borrow money? Where does the short rate come from? The short rate R in the equation, where does it come from? Huh? It comes from government repo. It's what you, more or less. Or it comes from the T-bill. But let's say the really short term, 1 day is the repo. Then the 3 month is the government. But Okay, in Brazil you have DI, which is a little, you have but abroad there is something like DI now called overnight index swap. But the repo is the idea that you can take your treasuries, your government bonds and your mortgage-backed securities and pledge them and lend them out for one day and then, or borrow them from one day, that creates an interest rate market that is in the trillions of dollars. GCF means General Collateral Fund. Can't go into that, but General Collateral Fund means you put in a security, you may take out another one. It's general collateral, it's just, it's fungible. It's almost like money. Bonds that are interchangeable. The DTC, created in 73, value in $1 trillion, okay? It does settlement services, global tax. The DTC is one of the plumbings of the American, system. Now we go into these are not for derivatives. Maybe repos are derivatives. Now you go into CME. CME has exchange traded derivatives. That is futures, options, Eurodollar, E-mini, T-bonds and notes, crude oil, and natural gas. These are similar to what you have in Brazil in BMF, in the old BMF. And then you also have OTC financial derivatives, swaps, interest rate swap, and OTC energy derivatives. Okay? This is from their website. They have, because these people are entrepreneurial, they have an American CCP and a European CCP. Because so the American CCP has its US law, has a certain structure. The other one is EMIR compliant, it's English law. With Brexit, they're going to have to change that, I assume, or something's going to have to. Those are the things that move the industry, right? If Brexit happens, what happens with this thing, right? Does it move to Frankfurt? Does it move to Paris? And what law is used? Question? Yeah. You move where? Vienna. Why not? Why not? Why not? But it has to be a friendly place that accepts, yeah. It's like and so the execution, see you have the exchanges, which are CME markets. This is the Chicago Board of Trade for bond futures, NYMEX for energy, CME for interest rates, swaps and options. Then you have clearing, OTC, commodities, rate swap, CDS, foreign exchange, futures, CME Clearing US. The clearing member is a FCM, it's part of the law, CFTC, Futures Commission Merchant. And in Europe, it's a broker bank, clearing member according to the English law. And so all this is nice, and so this is what CME is right now, right? And CME OTC Financial Derivatives, you have in Europe, for example, you have vanilla versus floating, you have fixed versus floating, amortizing swaps, basis swaps, which means you trade two different floatings, zero coupon swap, overnight index swap, forward rate agreements, and you have all these maturities. So they do a lot of products. And these products sometimes are portfolio cleared. So this is, and exchange traded products, we're not going to go too much into that. We already know you have all these, futures, and you also have OTC. The other guy that I want to go to the website to tell you what these businesses do is ICE Clearing US. You have agriculture, where they do a lot of futures, sugar, cotton, coffee, cocoa. So coffee you have in Brazil, but you also have in ICE. If you want to arbitrage a coffee contract or whatever, you have cocoa also. Do you have cocoa in Brazil? Chocolate? You have cacao futures? No. See, there you have. Why doesn't Bovespa have a cocoa futures? There's no liquidity. Why? Huh? Yeah, but it's a question, the question of Brazil is that Brazil has its own law, it has its own agriculture, its own seasons, right? So for some things it's completely impossible the contracts are not fungible at all between Chicago or between Atlanta, and this company is based in Atlanta. This company has a very interesting history. It actually is very technological. It's much more advanced than CME. And the technology was taken from Enron, from my understanding. When Enron, the big energy conglomerate that went belly up in 2001, 2002, Enron wanted to be the big dealer. It had a website where you could trade weather, energy, oil, derivatives, whatever. But of course, they did not, it was all a big, thing. It was not real. They actually committed fraud. They lost a lot of money. They were like a losing money company. So everybody said, oh, and some people realized that Enron had a very good technology. This is the story that was told to me by an executive from ICE. I can't say it's completely true, but then that is the basis of ICE. And ICE headquarters and data center in the US is based in Atlanta. And then you have another office in London as well, and in New York and in Chicago. Chicago is for credit. Atlanta is for commodities and interest rates. And then Europe is, in Europe, they're not doing so well, I think. No, they're doing well in credit. So equity derivatives, forex, metals, credit. Credit is very big in ICE because ICE dominates credit for the reason that I told you before. So you have credit default swaps, equity derivatives, interest rates. They're not very big in interest rates. Interest rates, the big clearing. So the message here is that clearing is not just some kind of nice wishful thinking, it's a business. And the guy who gets the business of clearing, it's like an exchange, it is very, very profitable to clear. And also, no clearing, no trading. So if you have a clearing house, maybe, for example, in Brazil a few years ago, there were these, when in the height of high frequency trading in Brazil, there was a market called Direct Edge or some other guys from New York that came to Brazil and said, we're going to do high frequency trading. Bovespa is prehistoric. And Bovespa says, yeah, but where are you going to clear? You still have to clear with us, so because we are the clearinghouse. So that makes the model non-economic. Actually, they went and did a study, and the study revealed they did it with somebody from outside Brazil, and they said, no, there's no problem. You could have two exchanges. Of course, exchange doesn't make that much. It makes about less than 50% of the fee is exchange. The rest might be clearing. It's back office. It's a big work. For example, Bovespa's last time that I saw, there's a floor which is 3 or 4 times this with a lot of people. We're looking at computers, looking at the accounts of all the clearing participants all day long and measuring that they have the right amount of initial margin and guarantee fund. And if not, they pick up the phone or they send them an email very fast. And that works all the time. It's right? That's how it is. That's the company. ICE Clear Credit, the main number to look in this slide is 30. There are only 30 clearing members. That's a very small number compared to Bovespa or to CME futures. These 30 clearing members are the 30 credit swap dealers. They're Goldman Sachs, HSBC, Bank of America, JP Morgan, maybe Itaú. I don't know if Itaú is a clearing member of ICE. Maybe it is. So the point here is that these guys, total. See, for example, they trade 144 index swaps, index credit swaps, meaning, both in the US, they have series because every 6 months they launch a new product, the old product is there. They have 400 corporates, 27 countries credit, and they have 65 indices, single name 176. This is US, right? So in the US you have 440 corporates, 27 countries, and in Europe you have 176 corporates, 7 countries. You can even guess what countries they are. Probably Greece is in there. And then you have, the total. The members are not very much. The members are small because to be a member of ICE Credit, you have to have a lot of money in the guarantee fund, like $2 or $3 billion. So not a lot of people have $2 or $3 billion lying around that they can just put into a fund forever. The guarantee fund of the United States is about, the last time I looked was 10 billion. I haven't looked in a while.
Is this only SDS or also bond?
This is CDS. Yeah, I mean 22, 12. You know. Maybe it's 12, but they're divided in 22 entities. But it's the mess. In the United States, I thought they were 10. It says 30. But one could be Bank of America Securities, Bank of America International. You know, and they have different contributions to the guarantee fund. The point is that if you look at the number of clearing members of Chicago, they may, or let's say one that I know by heart, Options Clearing Corporation, 200 clearing members, 200 plus. So it's more all big brokerage houses, you know, all people, hedge funds can be clearing. Here you need the $2 billion to play. You know, not a lot of people have $2 billion. And Chicago, it makes, and then when you have a big piece of, this is an important point, which we're going to come to quantitatively next. When you have 500 clearing members or 200, you can ask them for $5 million each. And then you're there. If you have 100 clearing members of $5 million, you have $500 million. Yeah. But when you have, but here, because it's a club of OTC dealers, there are only 10 or 20, so they need to put more money. And there was a big deal because Dodd-Frank said everybody should be able to clear, so the members should be able to clear. And you know, that's another point. You know, if I want to clear, I'm a hedge fund that wants to clear, then these guys are going to say, wait a minute, do you have $2 billion? No, then we don't want you in our club. You have to come through us. Or if you want to clear, then, so there's a lot of legal issues there that are very important, some of which have been resolved already. So here are the 4 clearing houses of Brazil. This, I guess, is BM&F, the old BM&F, which is derivatives. Then you have equities and securities lending, which is called CBLC, you know, the clearinghouse. Means Brazilian Company of Lending Stocks, you know. And it's good because they have a table, not only it's also an exchange. That means that you know how much it's going to cost to rent a stock. In the United States, you have no idea how much it costs to rent a stock. You have to find out by asking people. It's not centralized. Here, there's a centralized exchange for lending and a clearinghouse. Then you have bonds. I don't know much about this. And FX, I don't know much about this. I know this is connected with a lot of, you know, Brazil, FX is very big because central bank. You have 10,000, these are round numbers, about 10,000 derivatives account and 500,000 equities account coming from the old. Am I right? Maybe I'm exaggerating a little bit, but big numbers. Maybe I'm a little big, they're less. Yeah. Yeah, only banks here. Yeah. But here you have, I'm sorry, here in the equities and securities lending, you have some accounts. Yeah. So full client segregation model is a laborious model. Maybe one of the reforms in Brazil, if you want to make a reform, is move away from full client segregation and say, become more Anglo-Saxon, you know, just omnibus, and that's going to be cheaper. I don't know if that will be well received by anybody. Because if you have it this way, why would you make it cheap? You know, if everybody's used to this, why change, right? Right? Okay, now the CPSS IOSCO principle, let me know, how am I doing for time? Is anybody here? Jorge? Eu tenho até 6 horas, né? Tá. And when do we have a break? Good. So I'm going to go over CPSS IOSCO very fast. This is going great. I thought I wouldn't go through this. So CPSS IOSCO, you need it. As a quant, you need it. I hope I'm not boring you too much, but it's a story. It's like a little movie. So you have the financial market infrastructures, the BIS calls them payment system, depositories, security settlement systems, central counterparties, and trade repositories. We're interested in central counterparties. So what are the general principles? Each of them is deep, if you really think about it. The first one is called general organization. Okay? General organization, it says, you know, how you have to have a strong legal basis, so you have to have the ability to not to give your collateral to the judge. You know, you have to be able to claim the collateral first. Robust government arrangements, that focus on the safety and the stability of the broader financial system. And then this looks very boring, but for example, do you know that the Kirchner government did a trade? They had an open positions for 17 billion US dollars in futures after they lost the election. So they had settled, you know, the election in Argentina, they had a managed currency. The election in Argentina was, say, in December or in November, and the minister, a guy called Kichilov, he had $17 billion seller of dollars at this crazy price that they had invented for March 2016. And I said, how can you do that? That's a huge number. So I looked at the position limits in the ROFEX, and then, you know, they said, everything looks like in Chicago, right? But it's not like in Chicago because the CVM, the CVM of Argentina has no legal power whatsoever. They can only talk. They can't do anything. And the government was co-opted, the central bank was co-opted completely by the government, and the exchange was completely co-opted by the CVM and the central bank. So they let the government basically be monopolistic seller of dollar swaps. That's a disaster. That's a disaster. It shows that these laws are important. If those laws don't exist, then the whole thing is a fiction. So, okay, I got a laugh from you, that's good. So you see, you have to see, in this business, it's all about cheating. That's what I love about it. It's all about finding the crooks. See, when you do math, it's all about, is the theorem correct? Here it's all about, how can you steal money? It's much better. It's more fun. You're a detective. You say, what is the governance for? For example, in Hong Kong, just very fast, there is no monetary authority. There is a monetary authority, sorry. They do monetary policy, but where there is no central bank. There are 3 banks, Standard Chartered, HSBC, and Bank of China, that issue currency with different pictures, right? And they're clearing members. So, you know, and they have collateral in Hong Kong dollars with a clearinghouse. So what prevents the bank from just, I don't know, it looks like a little, and they're also what they call clearing banks. So the clearinghouse doesn't have a bank. In the United States, it has a bank. That's part of the principles. But it could be that they use the central bank to put the money. That's the Brazil, the money in Bovespa should be in the central bank, right? Where else can you put the money? But and there's no central bank in Hong Kong. So the clearinghouse funds are with clearing members. So what are the clearing member defaults? And you have, you know, what do you do? So then there's a lot of language around that, you know, to prevent that. So these are real issues. I'm not criticizing. So this is where the quants have a say. CCP validation. When someone gives you a picture like that, there's one place that you can beat the lawyers. That place is you have to read this language. Systemically important payment systems require to fully collateralize credit exposure to each participant with a high degree of confidence. What's a high degree of confidence? CCPSS with more complex risk profiles, systemically important, should be required to withstand at least the default of 2 participants that would cause the largest damage. 2. Address the management of the collateral. Is the collateral in a bank that is a clearing member or what? Set margin requirement for CCPs, confidence level of more than 99% in terms of initial margin. That means that you have to check that the initial margin VAR is more than 99%, or it has to be better than 99%. And then you have to do back testing and blah, 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 and guidance against wrong way risk, procyclicality. Wrong way risk, you saw it this morning. Procyclicality is when you raise the margin requirements when there's a shock to the market. So everybody has to put money when they're losing money. So you don't want that. That's a no-no in this business. Your margin has to move slowly. And then you have to have a lot of, so this principles 4 and 7, that's where they used to call me desperately saying, I need you to tell the regulators that I'm okay on CPSS IOSCO 4 to 7. Then there are more rules, liquidity, you have a lot of back testing to do. So this is all 4 to 7. Full validation of risk model at least annually. and FMI, financial market infrastructure, to use the results of these stress tests to evaluate and adjust its resources. So then you have settlement. This is just payment. Make sure you get paid, you know. Exchange of value settlement. These are boring things. Immobilized form, blah, blah, blah. Default management. This is complicated. What happens if someone goes belly up? You have to handle participant defaults, maintain rules and procedures. Operational risk, you know, so these are the IOSCO principles, and transparency, which is very interesting. I don't think that CCPs are very transparent in general. You know, they have a certain degree of transparency, but they never tell you how they calculate the margin in full detail. Maybe that's good. So basically, what I told you so far, now we have a break, is there are these things called CCPs. They're there to control systemic risk. You've probably heard about them, but you don't know how it works. They make a lot of money and compete with each other for markets. And they are bound, sort of by gentleman agreement, to follow IOSCO rules and their laws in the different countries. In the United States, it's a rule written by the CFTC or by the SEC. In Europe, it's EMIR. In Hong Kong, it's the Hong Kong Monetary Authority. In Brazil, it's Bacen, or Banco Central do Brasil. So these people are basically reinterpreting IOSCO and trying to be good citizens of the world and provide good protection against systemic risk in this business. And this is part one. What am I going to do in part two? In part two, I am going to tell you quantitative stuff. For example, how do you check that a guarantee fund is well capitalized, right? What would you do if someone asked you? What would you do as a quant if someone said, show me that the Federal Reserve of New York wants to know whether you have enough money in the guarantee fund? What stress test would you do? Then I want to talk to you about the IM of the Options Clearing Corporation. Not too much time because we did it last year. And then the IM of CME for credit default swaps. And then after that, we'll close with some comments. That's not